Joe, good to see you. Thanks for making a bit of time to come and have a chat. Appreciate that. I want to kick off by reflecting something that we talked about last time we were talking. You said that somebody had said to you, if you pull this off, you should win the Nobel Prize for Economics. Now, that sounds like it could be fun. Why were they saying that to you? Tell us what it is you're trying to pull off.
Um, yeah, what we're trying to do is and I'm going to oversimplify for the sake of the discussion, fix how we fund entrepreneurial capitalism. This very prominent person that said that understood the implications of what we were trying to solve for the first time, my first attempt at what we're doing now, which was 26 years ago. So these comments surfaced 26 years ago and actually have surfaced from some other people recently as it's actually starting
Right,
to get some traction.
right.
But it really comes down to that single conclusion. If you change how entrepreneurial capitalism is practiced, that has profound implications for economic development,
Yeah,
human development.
yeah,
A lot of the things that people talk about when they're trying to foster entrepreneurial capitalism in their community, it's jobs creation, it's innovation, it's and the entrepreneurial journey itself is a remarkably uh, intense and extreme use of all your human skills.
yeah.
And thus, it takes you through such a remarkable journey of emotions. You know, the scope of emotions you experience as an entrepreneur is really remarkable.
Yeah. And
Um,
and let me ask you, Joe, what is it you want to change about that? I mean, I can see there are some bad bits to being an entrepreneur, and there's lots of problems around, helping people innovate. I mean, what is it specifically you're focused on? What is it you want to change? Because that's a big thing, changing capitalism.
yes, it is. That's a very large thing. At its core, if you've studied Silicon Valley's history, which is the epicenter of really
Yeah.
where entrepreneurial capitalism really accelerated, entrepreneurial capitalism has been around forever. You know, the notion of an angel investor, some people say the Medicis were the first angel investors, or Queen Isabella funding
Yeah.
Christopher Columbus. You know, that exchange of somebody of substantial wealth supporting the entrepreneurial efforts of somebody else has been around a long time. But it really was refined and went to another level post World War II in the United States, largely to monetize and do something with all this R&D that resulted from spending money in our national labs and in our universities to create new war technologies,
Yeah.
if you will, right?
Yeah.
Post World War II technologies. And it really took off in the late 50s in the United States. There were some early experiments when there was some legislation passed called the Small Business Investment Act of 1958. The problem is in the venture, how we fund innovation today is largely the same as how we funded it in 1958.
Right. Okay. So you're saying that
This
needs to change.
that we need to modernize the very process of how we fund innovation. Because if you create a more efficient flow of capital, this is sort of economic
Yeah.
theory and financial theory, you both de-risk that which you're investing in. If you increase the liquidity and the flow of capital,
Yeah. Yeah.
right, you actually de-risk that which you are investing in, that asset class, and accelerates its effectiveness and success.
Yeah. So how are you
Okay.
going to do that? I mean, I get the logic of your argument. I mean, I've got an economics background myself, so I get the argument you're making. But it's very easy to say that. It's much more difficult to do. I mean, what is it? How are you going to do that? Give us a flavor of what your thinking is
Oh,
about
sure.
changing that.
Yeah. Well, if you unpack um, again the current process of how entrepreneurs
Yeah.
source capital. All right. Now I'm talking about raising money from investors,
Yeah.
equity dollars. I'm not talking about bank debt and those sorts of things. That's not typically a source of capital for the entrepreneurship we're talking about. Um, the process of how entrepreneurs source capital is they have to go and pitch somebody. They have to
Yeah.
sell the idea to an individual in an analog exchange, a face-to-face exchange. That's what needs to be fixed first. Is the pitch process itself is the cornerstone of why it has remained so archaic, a la
And let
the
me just
same
ask you,
process
Joe,
as
let me just
1950.
ask you, why do you feel that that pitching process specifically needs to change? I mean, I get your point about it's been around for a long time. Why do you think
Yeah.
it changed? Because lots of people would say actually that process is really good. I mean, lots of investors, they love it. They get people to come and pitch at them and they can just pick and choose. I mean, it suits investors fine. What do you think's wrong with that?
Well, what you just said is a big part of the problem. Investors get to sit back. You're pandering to the money source in this
Yeah,
context.
yeah, yeah, yeah.
Okay. You're pandering to the money source. And these investors get to sit back and have the entrepreneurs come to them. So let's pull the lids back from the venture process. Where else do other people invest their dollars and own equity interest in other companies? Well, that's investing in the public markets. When you're buying shares of a publicly traded company,
Yeah.
buying shares of a company, just like venture capitalists are buying shares, equity interests in a startup, a non-publicly traded company, private company. Well, in the United States, and again, I'm basing my activities on the U.S. financial system. I
Yeah,
can't
I get
speak to
that.
the world's
Yeah.
financial system. I'm not a student of that. I have been a student of economic history and theory in the United States. Um, Prior to 1933, if you were a publicly traded company on the New York Stock Exchange, the process of investing in those publicly traded companies looked a lot like how we invest in startups today. It was all done in a face-to-face exchange. Prior to 1933, there was no standardized reporting requirements if you were a publicly traded company.
Right.
You
Okay.
didn't have to adhere to standardized accounting practices. In the United States, that's called GAAP, generally accepted accounting practices. Um, there was no requirements to communicate in any sort of accurate, consistent, standardized way.
Yeah.
So you had a lot of the investors were also at where the companies were headquartered, New York City. That was the corporate headquarters for 200 years.
Yeah.
So the investors would go have inside information and have a face-to-face exchange and get what they claimed to be an asymmetric information advantage. And they would invest, or as the brokerage industry, they would sell those ideas to other
And
investors.
what, just explain for people that aren't investors, what do you mean by an asymmetric informational advantage? I mean, just explain that for people so they understand what you mean by that.
Yeah, I'm sorry for that. Thank you for correcting me. Good inside information
That other people don't have. That's why you
that other
get an
people don't
advantage.
have. That's exactly right.
Yeah.
That's exactly right.
Okay.
Asymmetric information is simply you have more valuable information that somebody else has on the same situation
Yeah.
that can make your decisions better, either buying or selling.
Which
Right?
reduces your risk, doesn't it?
Which reduces the risk. That's at its cornerstone. That's exactly. So back in the 20s, when we had the roaring 20s in the United States and the speculation in the stock market, that was all done without any of the regulatory structures that we have in place since 1933. And that's what magnified the distortion of the bubble of 29. It caused a lot of unsuspecting investors to lose money in the stock
Yeah.
market. And
Yeah.
the insiders were the ones that were principally winning. The people that were claiming to have an inside information advantage, and then were distorting the use of that for their own personal gain. Well, that exchange we just described is very similar to the venture industry today, principally now these large venture firms.
Okay.
So what happened after the crash of 29? FDR gets elected. We have the Great Depression, or the beginnings of the Great Depression. And the first thing he did was establish the Securities and Exchange Commission and pass legislation
Yeah.
called the Securities Act of 1933, right after he was elected, to clean up Wall Street by establishing standardized reporting requirements to external investors. So there wasn't this inside information opportunity. In fact, you could standardize. Now, what that did was, and if you look at the legislation, it said in an act of risk management, we're now establishing the first standardized reporting requirements if you want to be a publicly traded company. That's called the 33. And the SEC was formed to enforce them. And it was an act of risk management. That was the intentionality. If you look at economic theory or information theory, if you want to lower the friction costs, is a physics term, think of it as risk in the investment world. Standardized reporting lowers risk. because it lowers the friction cost and improves the flow of information. Efficient flow of information leads to efficient flow of capital.
Yeah.
That's a
But
fact. It's a law of
yeah,
physics.
I get that. So what you're saying is that you want to standardize the information that VCs use to invest. I mean,
First part
how do you do that?
that yeah, that's the first part of our business is to because my prior career I was a money manager. And people would call us a quant. We only made data-driven decisions. We didn't talk to Wall Street analysts. We didn't read their research reports. They're highly biased and inaccurate. We didn't talk to managements to try and get inside information ourselves. We simply used data to define who we wanted to buy and what we were willing to pay for it and the like. The reason I could do that, and we were very successful from a track record and from all the usual metrics of investment management. The reason I could do that is because I had access to data. The reason I had access to data was because the data vendors could go in and extract these standardized reports that come from publicly traded companies, 10Ks, 10Q, audited financials, et cetera, do whatever their secret sauce was to make that information more usable for us to find investable insights. Well, that's the first thing you have to tackle is standardized information. Now, I'm not suggesting that becomes a regulatory requirement like the 33 Act required of publicly traded companies, but that's the first thing you need to do if you want to invest better. You first have to have good standardized information.
And why are you, just to pick up the point you just made, why do you think that shouldn't be imposed on people? Why do you not think it should be a regulatory requirement for that sector? Because if it works, if it's such a good way of leveling the playing field, why wouldn't you want to do that in private markets and for VCs and so on?
Two reasons really that I've encountered. There may be more. Excuse me. First is for a new company, a startup, if you will, in those earliest stages of its build out, where it's still basically running experiments. It's an R&D phase.
Yeah.
It's the business equivalent of R&D, right? You're figuring out your business model, you're figuring out your customers' real wants and needs, and whether what you want to try and build actually has a marketplace. It's like metaphorically, it's like a green shoot plant, just getting started growing.
Yeah.
Put other burdens on that plant that's trying to grow, you're going to stunt its ability to grow. It doesn't need at those earliest stages for regulatory requirements. That's an added regulatory burden I don't think early stage companies need to bother with. Okay, I don't think that's a burden. Now, the other thing is, as we've now seen in our business experience, and there's also lots of research on this, the act of being willing to be transparent on behalf of that CEO, their willingness to be transparent is a wonderful due diligence criteria because it's a voluntary act, which is a choice that the CEO is making. And that gives you the opportunity to get inside their head. How serious are they about their business? How comfortable are they with the information feedback that will come from that voluntary transparency?
Yeah.
In fact, there was a research study published in TechCrunch back in 2020 done by a professor in, I believe, Switzerland, with a whole bunch of venture data studying this issue of transparency and entrepreneurial success, looking backwards. So studying the behavior of the portfolio of companies that the VCs offered that were successful, had positive financial outcomes, and those that weren't. Isolating only this relationship of the behavior of relative to transparency, not of the other due diligence criteria, size of market, and blah, 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 blah. But isolating the singles issue. And what they found was those CEOs of startups that were properly and voluntarily transparent.
They got a competitive edge. What you're saying is they got a competitive edge from doing that. Is that what you're saying?
With the benefit of hindsight, they dominated the pile of successful startups just from that one singular voluntary act. And the pile of unsuccessful startups, regardless of how much money they raised, who was on the cap table, all those typical social signals that trigger most people's investments in startups today, had no correlation outcome. And it was, in fact, the absence of proper voluntary transparent was dominant amongst the failed ones, irrespective of all those other optics and social signals. So it's literally based on absolute fact. It's the single greatest due diligence criteria you can start with as an investor to be more successful.
Okay.
is if that CEO was properly
So
voluntarily transparent.
I get that. So what you're saying is that CEOs of early stage companies should be a lot more transparent because that helps them get investment. And there's a pretty obvious logic to that, isn't there? I mean, if I was going to
That's
invest in a company, if I know what's going on, I'm going to be a lot more comfortable about that, or at least I can make a
exactly.
judgment about in being in or out. How does your business help with that? I mean, just explain that. I get the logic. Explain how
Mhm.
you do that because it just seems to me that's a good piece of advice. I mean, any CEO could take that advice away and just go do it.
Right.
How do you? I mean, what's your role in developing that?
Yeah. Well, again, I'm a kind of a nerd, a research nerd, and a process nerd, and I don't invent shit. All right. Pardon my language. Uh, there are plenty of examples of that function is called investor relations. If you
Yeah,
look at public
yeah,
companies that are required to do it, they have an investor relations division to satisfy their regulatory requirements of transparency and reporting.
yeah,
Okay. And if it's a smaller publicly traded company, there are professional firms you can outsource this function to.
yeah.
They really come from the PR world. It's an adjunct service in the PR world where they can adhere to solely not from a marketing and PR, but in fact this regulatory reporting function
Yeah.
where they'll do the writing, curation, and production and all that sort of stuff. Well, that's the business we built. The first thing we built was the first professional investor relations service for startups.
Right.
And the structure of that, the intellectual property we licensed, was the only GAAP-like reporting structure that's ever been developed for early stage startups.
Right.
Now, a lot of people in this venture industry, because they like to be pandered to, they like to be pitched,
Yeah.
right? The industry loves that. It satisfies the egos of these VCs to have these entrepreneurs come kiss their venture ring and plead for money. Which is offensive to me. Um, the industry, even though it's called the Bell Mason Diagnostic, specifically the first and only purpose-built framework that is recognized by those that know it as the most rigorous way to track the operating performance of a startup from its inception.
Right.
And because of Coopers and Lybrand, now PricewaterhouseCoopers, they got involved. This is the late 80s, by the way, just to tell you how long it's been around. And they said, well, if it's the right thing to do to build a company methodically from the ground up, that makes it a GAAP-like equivalent for external reporting because you're defining what are the relevant value
Yeah.
creation operational activities that need to be communicated externally in a standardized and organized way. So they got involved and literally validated it as the only purpose-built GAAP-like, because even GAAP isn't that relevant for the early stages of the startup journey
Okay.
when you're in this R&D experimentation phase, because your income statement's pretty much useless as a financial analysis framework. All the activity for a startup in the earliest phases is building balance sheet assets so they can hopefully build something that the market might want and they can then monetize it. And that's where the income statement becomes a relevant financial analysis tool. The Bell Mason diagnostic was specifically built to identify what are those relevant activities and that you should be doing and sequencing them.
Yeah.
When should you be doing these relevant activities? Which is what Cooper's recognized as well. It was scientifically defined and framed to be what you should be doing, which means it's what you should be reporting on. Well, Gordon Bell, the principal architect, who's the inventor of the mini computer, he's an iconic figure in the history of technology.
Yeah. Yeah.
Um, First winner of the von Neumann medal, which is the Nobel Prize equivalent for technologists. He was the architect of that. He's an investor in our company. We licensed the Bell Mason diagnostic to define this first business we built, which is the first professional, proper investor relations for startups. So startups hire us, just like there's public company
I get it.
business
Yeah.
model,
Yeah. Yeah.
to produce these monthly updates, quarterly reports that captures and reports on the relevant operational progress they're making, not what the entrepreneur wants to pitch or what the venture capitalist wants to be pandered to and sold, but in fact, an objective framework to track longitudinal performance analytics. Now, in doing so, the Bell Mason diagnostic created Gordon and Heidi Mason, Gordon Bell, and then Cooper's Lyman created a way to convert these, which largely qualitative activities, filed for IP secured, right? Well, that's a balance sheet asset. How do you value the accomplishment of that? It's very difficult in a calculation sense. So they created a scoring system to assign a score to these various operational activities that are the relevant value creating necessaries. It's like building a building from the ground up. We put the foundation in properly and that got inspected. Well, you can't value that in dollar terms, but you could put a numerical value to it so you could track the accumulation of these quantifiable milestone accomplishments over time. Now, when you can track in a standardized way these quantifiable value creating milestones, you now have longitudinal performance analytics. Now you have the equivalent of Wall Street securities analysis because it's standardized, objective, relevant, and longitudinal.
Yeah. No,
That's our
I can
first
see that.
division. Yeah, that's the first piece. Now all of a sudden you have data to make objective investment decisions, like I used to be as a quant. And our second division is called the legacy funds division, which is how do you manage money like a quant? How do you how can a venture capitalist actually manage a venture portfolio based only on data? Now that you have data.
Yeah. Okay.
And that's the platform we built. I've been researching the venture model for 30 years and actually have been recognized as the world expert in the optimal venture fund architecture. Because again, the industry itself has not professionalized. They've maintained this sort of pandering pitch model. The venture fund structure itself is largely the same as the first fund that was launched in 1959, which in and of itself was an accident. So the current venture fund structure is based on an accidental structure itself.
And you're saying there's
now
a better way to do it. And
now that we've got tons of historical data, you can now start architecting funds properly based on historical performance data. Like, what's a properly diversified seed stage fund?
Yeah.
What diversification is one of the foundational tenets of investment management, and yet the venture industry's never adopted it properly. What's the other risk? Systematic risk is market risk, timing risk. It's the number one risk in venture investing is timing risk. You could get everything else right, and you're either too early or too late, and the business fails. So managing timing risk actually is the number one risk to manage as an investor. And the only way to do that with any disciplines and structure is what's called dollar cost averaging. Staging your investment decisions over multiple time periods to mitigate thinking you're absolutely right or turning out to be guessing right or being absolutely wrong. You're literally dollar cost averaging. So these are some of the fundamental tenets and the research that we built into our legacy funds division to say, because that is modeled after the Investment Company Act of 1940. After the 33 Act that established standardized reporting requirements, in a further act of risk management, our government professionalized, if you're going to manage money for somebody else in a pooled account, they established professional standards in how you need to manage that fund. That's called the 40 Act in our country. Mutual funds, ETFs, any pooled account where you have minority shareholders fall under the 40 Act. Well, that's never been applied to the venture asset class, meaning what's a professional venture portfolio? How should it be managed? Because mutual funds look all alike, ETFs look all alike. What goes inside them changes, and that's what investors are able to buy is, I want to buy an ETF on Web3 companies or fill in the blank flavor of companies that are invested within that vessel called the ETF or mutual fund. But the structure is identical.
Yeah. Okay. So
I get more liquidity and less risk.
Yeah, I get your point about that, reducing risk, and I can see why that's important. How are you going to judge success? I mean, what would success look like, let's say 5 years down the track? I mean, what are you trying to achieve here? I get the logic of why it's valuable, the transparency piece and the standardized piece. I get that. How do you want success to look if let's say 5 years down the track? I mean, tell us where you're going.
The best way to think of it is our two businesses result in two different solutions. Together, it's the macro solution. In a perfect world, success would look like, because our legacy funds division, we built this as what's called a venture turnkey asset management platform, venture TAMP. There are TAMP equivalents in the public markets as well. We license that platform for free to people that want to run institutionally rigorous,
Right.
leading edge fund design. You choose what you want to invest in, what startup flavors. This fund will optimize your chance at success.
Right.
Risk adjusted returns, alpha. Regardless of what you choose to, this is going to optimize your chance of financial success for your investors. We license it for free. We help them use this data and analytics that comes from the Bell Mason Diagnostic and our investor relations service. That asymmetric information we've now created on startups that's actually intellectually honest and rigorous. And we help them manage it. We get a small piece of their profits, if you will, 50 basis points of the carried interest.
Right.
Okay, that's our economic model. Startups pay us as a professional service to produce this, just like you hire a CFO to get your book straight. They hire us to get this external reporting communication straight.
So where
that's our
do you want that
model
to get you to in 5 years' time?
Right. 5 years' time, if I could snap my fingers, we would have hundreds of legacy funds launched off of our venture team.
Right.
That would lead to thousands and thousands of startups using Angel Span for their reporting, because that's part and parcel. If you want to apply for funding, we built a funding application process. No more pitching. We've eliminated the need for pitching.
Right. Okay.
You don't need pitching anymore. Okay. You literally, entrepreneurs can apply for funding for a seed round, and then your execution and the evidence of you actually building a business that's hitting these relevant milestones, as the Bell Mason defines, informs your follow-on funding access.
Right.
That's our model. In a perfect world, we've got hundreds of legacy funds out there, because in doing so, and let me paint a picture for you. Let's say, for sake of example, there's a Texas legacy fund, meaning any startup in Texas, agnostic to location or industry, can apply to the Texas Legacy Fund. And it's a seed A and B round funding strategy, by the way. So it's, again, dollar cost averaging across 3 rounds. And we actually optimize on how much money you invested at all 3 rounds. And that's based on research as well. There's an optimal way to optimize your systematic risk management through making sure not only you're investing over multiple rounds, but how much money you invest at each round in the companies that make their way to the A and B rounds off the seed round. That's the model. So let's say, paint that picture 5 years from now. There's a Texas Legacy Fund, and it's working wonderfully. But there's also a Houston Legacy Fund, because there's people in Houston that want to support Houston startups. That's called place-based impact investing. And let's say there's a national AI fund. So entrepreneurs all over the country can apply for funding. And there's a national African American fund to support African American entrepreneurs. There's a national female legacy fund to support female entrepreneurship and access to resources. Okay, so the national female, national African American, national AI, we've got a Houston fund and a Texas legacy fund. A Black female launching an AI company in Houston has 5 pools of money now she can have access to, with one funding application, because every legacy fund has the same funding application. It's been researched on how to de-risk a seed stage investment.
Okay.
We're not trying to pick winners at seed stage. Nobody can.
You're just trying to de-risk the investment, aren't you?
We're trying to de-risk and get the entrepreneurs more efficient access to capital. That alone makes them less risky if they're not wasting all their time chasing money and spend time building their business.
No, I can definitely see the logic. I mean, it makes an awful lot of sense. So, I mean, I know you're not quite as far down the road as you want to be, but tell us a bit about the journey that you've been on so far, because you've been working on this for quite a while, haven't you? I mean, have you had any surprises along the way when you thought, oh, I didn't think things were going to turn out like that? I mean, have you had a few of those?
Yeah, this is my naivete. It's the training I got by being a money manager, and also as a classic multifamily office, I help clients establish their estate plans and dealt with intergenerational issues. It was a classic boutique multifamily office. We had old money DuPonts and folks like that as clients, and because we were located out on Sand Hill Road in Menlo Park, we started getting the new venture dollars that were surfacing. My boss and predecessor was really the fortunate thing for me. That conditioned me in a way that was both help helped me design and build this, but also created the surprises you're asking about. Because as a money manager, my clients trusted me. We had full discretion over their money. They also trusted me implicitly on a lot of other parts of their life, ancillary offshoots of their financial status. They paid for my opinion. And partly because they knew I would research it like hell before I'd ever. And if I said, they asked me to do something, I'd say, I don't know how to, I don't know. You want me to figure it out? And they'd say, yes, please. I'd go figure it out. The surprises I've experienced on this journey is in the venture industry itself. Remember, it's not a profession. There's no training required to be a venture capitalist. There's no body of knowledge you have to study.
No, no.
Right? There's no certification process. There's no oversight on bad actors in the industry. It's not a profession. Hell, hairdressers have to go to beauty school. And if they make a mistake, it grows out in 2 weeks. Venture capitalists, there's zero professional standards.
So what's the surprise? I mean, that's not a new thing.
The surprise is how the second and third level impact of that lack of professional standards. The venture industry never has to read about how to be a better VC. I've had 6 papers published in institutional investors journals. They've recognized me as the world expert based on all this research on how to design a better venture fund that finally shows innovation from the fund structure that goes back to 1959. And yet the industry doesn't read. Now, this is a little bit pervasive around our culture with social media and stuff. People have been conditioned to react and clickbait sort of thinking. But I'm just stunned at how little people read, especially venture capitalists who are in a fiduciary position. They have a fiduciary responsibility.
And do you know why they don't read? I mean, they seem like I've met lots of VCs. They seem like a pretty bright bunch. Why would they not want to read up on these things?
At its core, I believe it's because the industry itself has a perverse incentive feedback loop. Go back to the core of human behavior. They love being pandered to.
Okay. So I accept your point there. I mean, I can see why that makes sense. So how are you going to change that? I mean, if they like being pandered to, what's the incentive to switch to a model that is based on essentially better data?
Better everything, better process, better data. That's the journey I've been on. Is I've studied tipping points. How do you get to disruptions? What are the components necessary to get to a tipping point? And why do they happen? And what's the character traits? I believe, by the way, we are in that tipping point phase of the venture industry finally.
And do you think that is being driven by the way AI is being used?
No, it started happening.
So what's driving that then?
Finally, the industry's own acknowledgement. Bill Gurley, very famous VC with Benchmark. He did a presentation at the All In Summit. Jason Calacanis has this famous podcast called the All In Podcast. And they have this annual confab in Silicon Valley. It's a love fest for the typical Silicon Valley players. Well, Bill Gurley was a speaker at that in 2022. And his presentation to this audience was why venture capital is a bad industry.
Right.
And he lays out the facts. In 2021, when Sequoia changed their business model, in their public announcement of changing their business model, they literally spoke about how the industry, while chips have shrunk in size and grown exponentially in power and software's migrated to the cloud, the venture industry is operating the business equivalent of floppy disks. Now that's Sequoia. So I have leading voices calling bullshit up finally and acknowledging the need for change. They're changing their own business models to begin with. So we're seeing the evidence of change happen from the signals, from the leaders of the industry. Yeah. And that's what causes everybody else to have to. When you don't have that sort of behavior from the leaders of an industry that's not a profession, you don't have regulatory oversight, when you have the leaders, then you have the industry forced to hold a mirror up to themselves and say, no, we got to change. Now we have Silicon Valley Bank failed.
Yeah.
Right? The arrogance of the insiders, the arrogance that happened is a classic. I mean, people don't know who Kleiner Perkins was. Kleiner Perkins was the Andreessen and Sequoia of the 80s and 90s.
Yeah.
And nobody even talks about them anymore. So in the original old guard venture firms, that was fantastic. And again, there's a cycle. If you study human behavior and human cycles, there's a natural cycle where you've got unbridled power, which means unbridled ego, massive wealth, oftentimes sudden wealth, based on luck.
Yeah.
Not because they were great investors. They figured it out on the fly. At least the old guard has been. There's a wonderful video called Something Ventured. It's a wonderful window into the first gen of the modern era venture investors, which is the 60s, 70s, and 80s.
Yeah.
They're interviewed. It was wonderful. It was on Frontline on our public broadcasting. And they admit it. We didn't make it up as we go. Now, that's fine when it's a new industry that's trying to figure themselves out. Just like I give startups a pass because they're trying to do something that's never been done before by definition. If they're starting a new company that's real innovation, not just following Me Too SaaS business, but real innovation, they got to figure it out as they go because no one's ever walked in this path before. The venture industry had never done that before in any sort of formalized way like it started happening in the late 50s. So I give them a pass. But the industry itself, there's a great book that I think I mentioned to you when we first chatted about. It's a Brit, Oxford-educated Brit teaches venture capital at Harvard's Business School right now, Tom Nicholas. And he wrote a wonderful book on the history of the venture industry. It's called VC An American History. It's brilliant. Goes back to the parallels to the whaling industry. Wonderfully researched book. On page 311, he writes that it's ironic that the industry that funds innovation hasn't innovated. Mm. Now, you'd be shocked at how many venture capitalists I've talked to that have never even read that book.
Yeah. So, but let me I take your point. So how are you going to encourage VCs to innovate then? What I don't understand is how, because if I was a VC, I'm not, but if I don't want to put my hand in my pocket, I don't have to. That's one of the things about the VC industry and that's why people pander to them. If they don't want to put their hand in their pocket, they don't have to. How do you change that?
I want to put a pin in that point right there, which is a common perception, which is wrong. Most venture funds, the management fee, the 2% management fee, there's 2% management fee and 20% carry has been industry standards forever. 2 and 20 it's called. The 2% management fee is typically only paid on what's called committed capital, meaning money they've actually invested. They say we've just launched a $100 million fund. Well, they don't have $100 million in the bank. The investors, the LPs, have signed a legal commitment to fund how much they committed of that $100 million. But the money's drawn down as decisions are made and transactions are confirmed. Then they go out and draw down that money from those, and then they can charge the management fee on those dollars. It's well known that perverse incentive is in place to force money in the marketplace so you could get your management fee and start your next fundraising before there's ever any tangible evidence of how those first investments perform. So yes, they have a perverse incentive to spend money. That's what very few people really understand about the industry. It's perverse incentives.
Yeah. But I still don't understand. I still don't get how you're going to change that.
Right. Oh, how?
Yes. I get your point about the perverse incentives. I get your point about the transparency and the importance of that. How do you get people to sign up for that though? Because if it was easy to do it, somebody would have done it, wouldn't they? That's quite a tough ask. What you're proposing.
That's why it's taken me off and on over 26 years.
Yeah.
One is the industry itself had to recognize its own need for change, and that's happened in an accelerated way.
Right.
We have an email that goes out once every week or 2 weeks called Changing Venture Industry, where I actually capture and find all these other really thoughtful people also acknowledging and recognizing the need for change. Yeah. So it's not just me anymore. Trust me, 10 years ago, it was just me. 5 years ago, there was a few of us. Now there's a broad chorus of people taking a thoughtful approach to what's wrong and what might.
So you've mobilized a campaign, if you like.
I didn't mobilize it, but I'm actually capturing it. But some of these people are basing their conversation off of the papers I've now had published. People are finally reading them. Yeah. So yes, I've been slugging away at trying to educate people and let it be their idea. That's one of the things that I found about human behavior is so many people need things for them to change. They have to feel like they discovered this opportunity for change versus actually studying history and saying, well, gosh, history proves there's better ways to do this. And I'm just going to study history and adopt those thoughtful changes that's already well available in history. So that's one of the things I've had to learn, back to your original question of just how embedded so many people are in things, their own change in their own behavior having to be their own idea. I wasn't trained that way. I didn't manage money that way. I was paid to go do my homework on behalf of my clients, to do the research, not have it be my idea, but in fact, solve their problems through rigorous research.
Yeah.
That's how
And let me ask you,
turns out I was.
one of the
Let me
things.
answer your question. There is a slice of investors out there that have largely not participated in this historical venture narrative. They're not attracted to the shiny object technology, or they know better than to believe that these VCs make false claims of, I know what a good deal looks like. Don't look at my historical track record. That's what happens. No. There's a slice of money out there. I used to manage it. We call it legacy capital. You can call it old money, experienced wealth.
Yeah.
Okay. According to the best research I've found on organizations that calibrate that globally, that's about $60 trillion globally. Okay, of legacy capital.
Hmm.
In the United States, it's it's 50 trillion. 30 of that's in the United States.
Right.
$1 trillion. Now, that same slice of folks just in the United States gave away in the form of nonprofits, philanthropic donations, $750 billion last year. And that's been running pretty consistent last few years. $750 billion from that slice of wealth to nonprofits. It dwarfs how much they've ever invested cumulatively, or God forbid annually, in this entrepreneurial asset class, right? They're not trying to make money. They're using their excess resources for something other than ego gratification, bragging that I got into Anthropic's IPO. They're way past the need to be part of the cool kids club as an LP. But they do want to use their excess resources to define or further their family legacy and their family brand. Think of Maslowian self-actualized pursuit. That's the pursuit of legacy. It's the highest order of human satisfaction from pursuing successfully your legacy in a self-actualized.
And what you're saying is you're trying to tap into that. Is that what you're saying?
That's correct. That's the marketplace.
Yeah. Okay.
That we're going after. Okay. That's correct.
And let me ask you about. If you've said that you've been at it for about 20 years. Give us a sense of some of the things that you've learned along the way. We talked about some of the surprises you've had. If you were to go back to square one, if you went back, started from scratch, what might you do differently?
Yeah, that's the hard one, because there was a predecessor company to what we built. What we're doing now, the first company I launched April of 2000. Hired a CEO to run it. I studied how to start I've never started a company before. I was managing that multifamily office. I was getting active in angel investing, and my clients wanted me to help them. And that was kind of the catalyzing motivation, because I couldn't help my clients invest their legacy capital into what we now call impact investing. This is the mid-90s. I couldn't do it up to my professional investment standards. And that was sort of the evolution of how this idea started in April of 2000. That first company, the biggest lesson learned is we tried to boil the ocean, meaning that there was too many moving parts all at once. Now, we got them built. We raised $1.4 million, got them all built, had got to revenue. But 9/11 hit, and risk appetites changed, and the angel investing collapsed. And so there was no marketplace for that which we built. So I got impacted by timing being bad. I also learned that trying to change that much systemic change while having all these moving parts as part of your solution all at once was wrong. I've had to study change. Because for me, the way I think is I was paid to go out and find new information and apply it and help in the service of my clients. Well, again, that's not how most industries, change happens slowly. So I had to spend a lot of time getting inside psychology of people and how their brains work. So it's taken me a long time to really understand the intellectual inertia that's both the source of, the inertia to change, but also that inertia is what also can be triggered to a disruptive tipping point if you tackle it in a systematic way. And that's why I started publishing the papers and sharing the research and doing it in a manner that was very much a scientific approach to systems change. And then we couldn't force the timing of that change. We could just make sure the raw materials were in place so that the trigger point would happen at some point in a discernible future. And now we're there, by the way. So we are in that point of change in the venture industry. But what would I do differently? What I've tried to apply differently is that, you got to do things in more of a serial fashion than all at once, regardless of if you got to do it all at once to actually solve it. You got to take pieces to get the marketplace at least moving in the direction you want it to, at least components of the marketplace. So we started with the investor relations piece first, because that is the cornerstone. So that's why we built that thing first.
Yeah.
Because once we got the use case, we could build out the system. Because if you want to be the standard, Gordon Bell saw this when he invested in 2015 and we secured I was at his home in San Francisco, and he saw what we built, because I built it around the Bell Mason. I studied. He wrote the first book on how to start a startup. It's called High Tech Ventures, The Guide to Entrepreneurial Success. When I launched the predecessor company back in 2000, I went and found that book and read his book. That's where I learned about the Bell Mason diagnostic, was from his book. And he said, if you haven't ever run a startup, go find somebody that has as your CEO. So I did. Went and got a CEO that had startup experience to be the CEO of the first company. So long story short is that applying these lessons from a systems design thinking and process orientation, instead of doing all the components once and trying to have the complete solution, get the marketplace moving in nibbles. And so we did that with the Bell Mason. And what Gordon saw in 2015, when I was showing him just the IR piece and the structure and the reporting, and we'd be focusing on the Bell Mason milestones before we actually got all of the intellectual depth of the details that we needed, that we now have, for it to be a gap-like reporting alternative. Gordon saw this and he quickly understood. He said, yes, I see what you're doing here. Angel Span will become the trusted brand. Investors will come to say, why aren't you using Angel Span?
So, yeah.
That singular observation was absolutely, isn't it? That's the tipping point.
Yeah.
He got it right away. And he knew that you have to get the investors to understand how this is valuable for them before they even start down the due diligence process. Now, the existing system is never going to want this. We're not trying to sell this to the existing venture industry. Oh, they're too embedded in their old way of doing it. They're just like any disruption cycle. They're too embedded in, they can't change, nor do they want to. They've been able to monetize a perverse incentive system, and they're going to protect it. The National Venture Capital Association of the United States is a lobbying organization.
Yeah.
It's not a professional standards of practices organization. So, like I said, when you're studying systems change, which I had to, that was the biggest lesson of the first failure. My presumption that people thought like I did, which was so grossly naive. I didn't think I was that much different. I just would look around and say, why don't you do your reading? Read this. Read Gordon's book. Venture capitalists haven't read VC in American History, that wonderful book that Tom Nicholas wrote. There's that wonderful history, the documentary, Something Ventured. There's plenty of things to learn from if you want to do it better.
Yeah. Yeah.
But the industry is not incentivized to do it better. They're incentivized to perpetuate this cool kids club. I know what a good deal looks like because I got access to quality deal flow because I know people at Sequoia.
Yeah, yeah.
That
it's
is
difficult. It's always difficult to challenge the status quo, isn't it? I mean, that is often what these things are about. Is getting people to abandon the status quo and do things in a new way, and they really don't want to. Let me just ask you a similar question, but in a slightly different way. What advice would you offer to a rookie CEO starting out on your journey, or a journey like yours? I mean, what would your most important piece of advice be to somebody starting out on a journey like yours?
Oh, this is not new advice. Again, I rarely create new content, but it's well discussed, but I'm a living, breathing example of it. You damn well better care what you're doing.
Mm.
That sense of purpose. People say, I'm really passionate about this. Yeah, so what? That is a requirement. That's not a value add that you're passionate. If you don't have passion for the cause, you're going to fail. So stop selling your passion. Show it through your tenacity, through your behavior. Um, yeah, I've cared about this a long time. I've had some inspirational clients that taught me a lot. And these DuPonts, I'll be very specific. I was very close to the husband. The husband was the DuPont. The wife was from old Chicago money. But he was a remarkable human being. I was blessed to be able to get as close to him as I was. He was a true Renaissance man. His grandfather was Irene DuPont, the president of DuPont. He's lived that. It's the oldest money in this country. It was recruited to this country by Thomas Jefferson. The DuPonts were recruited by Thomas Jefferson and Ben Franklin to bring their technology and wealth, chemistry, gunpowder back then, to this new country called the United States after the French Revolution, before you get your heads cut off by the mobs of the French Revolution. So they moved here in 1801, brought their wealth and knowledge of chemistry, specifically in gunpowder. And so it's the DuPont history is a history of our country. And my client opened up his family archives to me. And I studied the DuPonts as a parallel of our country's economic evolution and the wartime evolution and all these sorts of things. But he himself was a remarkable man. And you asked the question on what would I learn differently? The passion. Oh, that's right. And he was my inspiration for my window into that what I call legacy capital. Because legacy capital isn't based on dollars or your last name. You know, if you look at the history of wealth in this country and versus European countries, if you look at the history of wealth in families, it's an interesting day. I have studied it. And it's one of the things that I love about America is it is the most philanthropically generous culture in the history of recorded mankind.
No, I'm sure you're right. Yeah.
We are a unique experiment called the American experiment. We're the first nation state to be founded on the first principles that were extracted out of the Enlightenment period. Right? The first nation state to be formed based on the wisdom of the Enlightenment. Our founding fathers were brilliant people. And we were founded by immigrants, entrepreneurs. The two cores for my research of American exceptionalism is entrepreneurial risk-taking and the gratitude and appreciation for what this country allows for you to do to change your station in life. You're not defined by, like other cultures throughout history, you're born into your status and you can't change it.
Yeah, and that's not the case in the US, is it?
No, it's what makes American exceptionalism so unique.
Yeah.
And entrepreneurial capitalism and the benevolent support of entrepreneurial capitalism. The benevolent intentions, not this ego-driven, unprofessional, look at me, I'm a venture capitalist. That is a violation of the core of American exceptionalism, which is benevolent gratitude and pay it forward mentality, as evidenced by the philanthropic donations, et cetera, and also risk-taking. And when either of those are suboptimal, it's an affront to our founding fathers to me.
Yeah.
And my client, this DuPont family, lived it with lots of other things. But he was a true Renaissance man, and he showed me the true, pure, what true self-actualized benevolence looks like, and how much of it's out there.
Yeah.
And
Joe,
that's the capital we're targeting
to
reward.
I mean, you talk about it with such passion. I mean, I think it's really interesting to hear how your approach to trying to innovate around or encourage innovation is kind of rooted in the history of America, which is a really powerful idea, I think, and that you can trace it right the way back, which is extraordinary. I mean, I spent a lot of time in America, and the lots of the things you've talked about are the things I love about America. I mean, I'm not that keen on Donald Trump, I have to say, but there are lots of other things I really love about the US, and it's really interesting how you're talking about trying to encourage innovation, but you're rooting it in history, which is such an interesting idea and story, and so unusual, really, because I mean, most financial innovation is not really not rooted that much in history, is it? Which is makes it such an interesting story. So Joe, thank you for taking a bit of time to come and talk about what you're doing. I mean, it's absolutely fascinating, extraordinarily different,
Appreciate that.
and like I said, I mean, if you do pull it off, I mean, I hope they give you the Nobel Prize for Economics because I think you probably deserve it.
Hey, I don't want it because what's allowed me to do what I've been able to do is I have a unique thing where I don't I don't like credit. It's really a funny thing is that people say you've got a big ego. I don't have a big ego because I actually don't like the attention and the credit.
Mm.
I don't. I don't want that because, like any successful venture, it ain't about one person.
Yeah,
The
no, that's
one thing
very
that
true.
I've had the blessing of is the exposure to these clients, this insatiable thirst for more information. That's a God-given thing for me. I do love learning new stuff, and I love history and the context that history gives you to make more informed future choices about the future. Some of those things are God-given, but any successful venture is a team approach.
Yeah, yeah,
And what's been so frustrating is watching this journey unfold and watching this, but it's almost a Shakespearean play playing out over the last 30 or 40 years. And look at the characters in the venture and see what it's doing today.
yeah,
It's just you could see history unfold right in front of you by seeing it. And by the way, if you study history, you also know how to fix it and or what's likely to come next and what can come next, and now we're actually at a point. Not only is the industry at a tipping point, the narrative has changed, but we now have people getting involved in our company that will be the catalyzing trigger for it to scale. And it's not going to take 5 years, by the way.
yeah.
So stay tuned.
Will do. Joe, thanks for coming on, and good luck going forward.
Thank you very much. Appreciate the time and you having me.
Cheers, Joe. Bye bye.
Bye bye.